So today's webinar is titled, the recession has arrived. I think there's no disputing that we are definitely in the midst of a deep recession in the United States and globally as a result of the lockdown across the United States and the rest of the world as a result of COVID-19. The economy basically hit a wall in March. If you look at when we look at the economy here in the United States, we typically look at three things in my office. We're looking at manufacturing, we're looking at services, and we're looking at employment. And so first off, manufacturing is shown on the left side of this screen. Manufacturing dipped into contraction in March, lowest level it's been in since the financial crisis. So definitely that was a telltale sign that things were contracting, but much more so you'll see on the right side of the screen, which is the services sector. This has been the brightest spot of the economy. It's also the largest percentage of the US economy. At almost 70% of the economy is services. So you can think, restaurants, movie theaters, go down the list, right? So if people can't go to work and can't go out, it definitely put a stop to this. And this has been the lowest level, the lowest decline ever on history in terms of the speed at which it had fallen. Other records that have also been broken is unemployment claims. Every single week on a Thursday, we get the number of claims that people submit for unemployment. And starting midway through March, those started breaking records, starting at about 6.8 million the first week, somewhere in the sixes and now in the fives. So when you total it all up over the last 4 weeks, it's over 22 million people that have filed for unemployment. Now, not everyone in that category is permanent. Some people could be temporarily laid off. So this is going to be a big question in terms of the recovery in the US, is how many of these people can get back to work. There's also been some programs put in place. You might have heard the PPP, Payment Protection Plan, where companies can get access to capital if they don't lay off more people, if they can bring back some of those furloughed workers. So we'll see if that begins to have an effect, as those checks just started hitting bank accounts literally this last week. But nonetheless, we've always said that you really can't have a recession if you don't have people that are going unemployed, and this is our reason for saying the recession has definitely arrived here. So since we are in the midst of one, the question is, what type of recession will it be? There's been a lot of symbols that we use, at least in what I look at on a day-to-day basis in terms of what the news puts out is potential shape of our recovery. We tend to look at our objective research through Ned Davis. This also sort of backs up the other things we've seen out of Goldman Sachs and some other trusted research advisors. Of really the four cases as we see the recovery taking place. Ned Davis puts 35% probability that we have what's called a square root recovery. Remember the square root sign, right? So you typically have a steep decline. All of this is a steep decline because we're in the middle of one. A steep decline in output, but there is a rebound that begins towards the end of Q3, and then in Q4, and then we have sort of a slow growth after that. So we remove some of the quick rebound, but we don't get all the way back to the top, but we start to grow more like the square root, and we eventually get back up to normal down the road. Equal probability is what has been touted by a lot of folks, which is a U-shaped recovery. Once again, that steep decline. We get some stabilization coming in the second half, and then the recovery begins to strengthen later this year, and it takes a year or more to regain the lost output, and then it's slow growth after that. These two together, they put it at a 70% probability. So both of these are the most likely, and this will go hand in hand with the amount of stimulus that I'm going to talk to in a moment that has been thrown at this thing. The best case scenario is a quick V-shaped recovery. That's like we go down, we come straight back, roaring back, all the stimulus goes to work, and while people are back to normal. That's a great case scenario. It is definitely possible, but definitely not the most likely scenario. And one thing we don't want, and this is, I think, what the market was beginning to price in, when we just didn't have any indication of what this was going to look like it was just a few short weeks ago, about a month ago, when the market was just cratering down, which is the worst case scenario, an L-shaped recovery, which means we go straight down and we go sideways. No recovery. We have credit crisis. We have wave of bankruptcies. This is more like the depression that has been touted by the worst of the worst financial media. We put this at the lowest probability, given the fact of, once again, the quick response by both the Fed and the federal government, and the sheer amount of money that has been thrown at this thing, and also given sort of the progress of the science of this, which I'll get into in a moment. So regarding the science, never before in my life could I remember a time when there was a website that I would log into on a daily basis that would track the number of people that have been victimized by a potential pandemic or sickness, and how many people would die every single day. And that's what World OMeter does for you, for those people that do look at it. It is, I think this makes it much scarier for folks. I'm trying to make this on a personal level. My wife is really nervous about this whole thing, and she looks at this more than one time a day. If you track cardiac, you have people that have cardiac diseases, automobile accidents, all these other things, also having very large amounts of the population that pass away from it every day, it would make you depressed as well. But yet this is one of the most trafficked websites in this environment. But the good news is you can use this to look at trends, and that's what we look at it for. On the left this is the United States, only looking at the US, not the world. We're looking at the daily new active cases. At the very beginning of this, we were doubling every few days here, and that was a problem. In fact, that was one of the reasons the market was continuing to sell off. It got worse faster than most people expected. I'm not going to debate, testing and all of that stuff that's in the media every single day about how this number is going to look going forward as more people get tested. But the good news is this is stabilizing. This is what they have been calling flattening the curve, and this corresponds very highly with the bottom in the stock market that occurred, at least the first bottom. So we have seen some sort of trend there. As you can see up by my arrow, it is an ever so slight decline, but it is not an outright decline. I've been focusing more on the chart to the right, which is the number of active cases. This is the number of people that are actually infected with the disease, that there's either, if you have the disease, you're going one of two routes. The optimistic, you're recovering and you're being removed from the active cases, or unfortunately, we have people passing away and they're also removed from the active cases. We have yet to see this one flatten yet, but it is very possible that it might in the coming weeks. So I think this would also be something to closely watch in terms of what, because the longer this is drawn out, which means the longer the country does not reopen, which means the weaker the recovery is going to be. So this is some good news here, and I think we've seen some stabilization in the market as these graphs would indicate. Now, perhaps the biggest, I've mentioned China a number of times in client reviews, and the number one thing I get back is we don't trust the data out of China. Well, it is the data, and I'm just going to go with the data that is published. And one thing we saw in China was a very similar sort of steep fall off in their activity. If we look at the top, which is a composite of their purchasing managers index, looking at both manufacturing and non-manufacturing. So manufacturing was China's primary driver of their economy, and they've tried to do what we're doing, which is transition to a service-based economy. So now there's actually a composite that tracks both of those, very similar to what I put on that first couple slides. And you saw this thing fall off a cliff, just like ours did, dropping all the way down to 30, worst level that they have seen, well worse than the financial crisis in terms of both of these readings. And we've also seen this snap back pretty quickly, as China was very quick to contain the virus and has gotten things back open again. And once again, I realize folks may say this is suspect, but we can look at American companies that do work in China, Starbucks being one that I happen to see a CEO, their former CEO on TV. I've been tracking them pretty closely because they're reporting that their stores are starting to open. So this is an area where potentially we can see some light at the end of the tunnel if we do begin to see a slowdown in the disease. The thing that has kept us probably the most positive about this has been the sheer speed and magnitude at which the government, both the Fed and Congress, have acted. As a person that was sitting in the front lines of the financial crisis, completely whipsawed day by day and what the Fed and Congress may or may not do, as partisan got in the way of Congress passing the initial TARP Act, as moral hazard came into play, was who's going to be saved and who wasn't going to be saved. Was it fair to save the banks when they're the ones that caused it? When the Fed was unsure what to do and to what level at which they could to help the markets, the Federal Reserve learned a lot from that, and I believe Congress did as well. And this is a series of all the different acronyms and things that have been put in place to fight this. And remember, this is 2 months that they were able to get this done. That is a record amount of time. I mean, Congress acting in less than a couple of months is amazing. They have thrown so far $6.55 trillion at this. That is an unbelievably large amount of money. It dwarfs the amount of money that was thrown at the financial crisis, and it represents 30% of GDP. I'm going to come back to this in a moment to what might be the longer term aspects of this, but this doesn't even include the last round of what the Fed announced last week that they're willing to do to backstop some of these, which could add another, $1 trillion or two on top of this number. So unprecedented, and I think this is, and this is showing their sheer will to basically do whatever it takes. And whether it's, the moral hazard thing's been thrown out. Hey, let's help them all and figure it out later has been the general tact at what's occurring here. So we have been looking at a playbook to begin to add to equities. We had a four-part playbook, and we called it the oversold, rebound, retest, and breadth thrust. In our last webinar, we actually threw in another one, which was rebalance. We did complete a rebalance of the portfolios and added, depending upon the accounts, anywhere between 4 to 5% in equities at a very decent price in the late March lows that we saw. We've been looking for this playbook to work itself out before we began to even consider adding more to equities. As our clients will know, we were fortunate enough to enter this period of time this year in an underweight position or a relatively conservative position with respect to our benchmarks in 2020. It was for different reasons. It wasn't because we saw COVID on the horizon and what might happen. We just were fortunate to be in that for other reasons due to valuation and optimism and such, looking for a better time to add. So we were able to take some of that capital and add as part of a rebalance, and we still have the ability to get to a neutral stance from our slight underweight today, and then eventually to get overweight and take more aggressive actions to capitalize on the decline. We're not there yet, but we have satisfied a number of these things. So we went oversold, we got oversold. We had that happen in March multiple times. We rebounded and kept trying to retest those lows, and we were waiting for what was called a breadth thrust. Now, breadth thrust is something that's known in my industry, but think about what it is, it's a massive move higher where all stocks or most stocks participate. And there's lots of different ways to look at that. I'm showing you two buy signals that we got on the screen here. A little technical in nature. The first one is on the bottom left. This is looking at the number of advancing stocks to declining stocks in any given day. We wanted to see 2 10-to-1, which means 10 stocks go up for every 1 stock that goes down. 2 of these in a row without a single 10-to-1 down day. We had a few of these occur with these big down days in between. We actually got this to occur in early April. So that was satisfied. Also late March, we had another breadth thrust satisfy on the right-hand side. That occurs when the S&P 500 is basically positive significantly 3 days in a row. That doesn't happen very much. The record since 1970s is perfect 1 year later. However, some of these, before 1970 weren't always perfect. What I'm showing you is the previous years since that period of time here. And you can see every case it was good with the looking at the average, the mean being about 20% higher after 252 trading days, which is basically 1 year. What you'll note though is that several cases in the 10, 21, 63, and even 126, which is half a year, the market was lower. So this isn't a perfect timing vehicle. I like to think of these things as green lights before we hit ignition. So we had our oversold, our rebound, our retest, green light, green light, green light, and then breadth thrust, another green light. So these are 4 things that are starting to signal that it's okay to begin to get aggressive. However, there's still a couple things we're waiting for. Very complicated chart here. I had no better way to show it than here. Remember, if we're going to be underweight stocks, we're going to have something instead of it, and right now it's bonds. This is another one of Ned Davis's proprietary indexes that look at everything, both what's external, which is things like interest rates and such, and internal, which is how the market's behaving. And it says, how does this model look relative stocks relative to bonds? When it's in the high levels, like 90% or higher, it means it favors stocks. When it's where it is right now, where I signaled with my pointer at roughly 19%, it favors bonds, sharply so. In fact, when it's at this typical level, bonds outperform stocks by about 27% per year, so on an annualized basis. Doesn't mean it's always been that way. It just means that this is, once again, we need to get the conditions to change a little bit in terms of getting the exact timing right. This shows us that we're not quite there, at least on this. So it's still favoring fixed income. So what we're waiting for is a combination of more green lights to come on before we would begin to get more aggressive in our equity stance. Once again, we were in a very fortunate position to come into this in an underweight to be able to have capital to put to work. And we did so with some. But before we go too much further, we definitely would like to see the news get better. That is not happening, and I don't think that's happening anytime soon. But we also want to see the market behaving well with more consistency. We're looking for 50% of these indicators to turn positive, and we're basically at about 25%. If we look at kind of what typically happens is it's been about 80% correct, which means we've got more than 50 show. The average rally that occurs is about a 21% rally that lasts about a year. So this would be something else we're watching in addition to other things before we feel like we can fully hit the green light. So we have 3 rules of investing. Our clients will know them well. Don't fight the Fed, don't fight the trend, and beware the crowded extremes. Well, don't fight the Fed. I would say that this is probably right now one of the most amazing points in time. I thought the financial crisis was great to have a front seat to. I think this even takes a bigger drawing for me. There's been a lot of talk of what's been called modern monetary theory. I get excited about this stuff, sorry, but I won't spend a bunch of time on it. But it's basically a theory that a government can go ahead and spend as much money as it wants to keep employment going, to keep the economy going, as long as it has the ability to print its own currency and not default on those promises. So federal government goes and spends a ton of money, giving people money for whatever they might need, some of the things they put out there already, and then the Fed goes ahead and prints the money to do it. The only caveat here is that you have to wait for inflation. Inflation's the only thing here that's going to drive when you can't do that. When you see an uptick in inflation, that means there's too much money chasing too few goods, too much money in the system, they got to back it down. Is it a theory now? I mentioned before that the amount of fiscal and Federal Reserve support that's out there, for people that might note, the CARES Act that was passed, the stimulus program, all in all, was roughly $2 trillion of spending. What we're looking at here is the Federal Reserve's balance sheet, and the Federal Reserve's balance sheet, I highlighted the wrong spot. I meant to highlight from February there, but it's okay. Federal Reserve's balance sheet is up $2 trillion. Coincidentally, it's the same number. Now, I'm not suggesting that they're utilizing this, but I think that it is a possibility, or it's a coincidence. And unlike the financial crisis, what I've been trying to tell clients that get deep in this stuff, and I'm going to keep it very simple, but in the financial crisis, there was a lot of money that evaporated from the system. If a person that was unfortunate enough to buy a house that they couldn't afford, let's say they bought a $500,000 house with $50,000 down, and then the 10% down, then the bank loaned them, and the house, let's say, was, effectively, they bought it for, $500,000, the bank loaned them the rest of the money, and effectively the house dropped to $300,000. So the investor, the person that bought it, was out their $50,000, the bank was out their $150,000. That's $200,000 on that piece of property. That money disappeared from the financial system. It wasn't just in mortgages, it was in the shadow banking system. It was all across these collateralized loans, and more acronyms I can throw out in this meeting here. That money evaporated, so the trillion plus that the federal government threw in, and the money that the Fed put into the economy, that was used to fill that hole that existed. In this case, at least so far, that isn't happening. In fact, banks aren't allowed to default. Consumers are in much better shape than they were before. Loan to values on houses are in far better shape than they were before. So $8 trillion injected into the economy, what might that do to asset bubbles and to inflation on the other side of this thing? That's definitely something to be watching. And that's one reason we've been telling clients, look, if you're concerned about what's happening here, I don't know that I'd put a lot of money into conservative treasury bills at the present time with them being under 1%. I don't know that I'd stick a bunch of money in the bank if you're just as an investment strategy at this point in time. I highly recommend having enough cash and capital to get you through this time. We've recommended that from before this happened, and even more so now, to have a moat of capital to be able to support your lifestyle without you needing to sell massive amounts of a portfolio if things go bad. But outside of that, I'm saying I don't know that it's the right time to get ultra conservative with an investment strategy given the sheer amount of money being printed here. So I'll keep it quick here. Don't fight the trend. How's the market behaving? I'll tell you right now, very poorly, very poorly. Market's not behaving. The trend is not supporting our move, which is one of the reasons we haven't gotten more aggressive. This will never allow us to buy at the bottom. The trend has to get better. On the left, we look at our flagship, which looks at how many stocks within a sector are up, how many sectors within the market are up. This is still on a sell signal. This is not looking great. On the right-hand side, we look at US versus international. And the international markets have been on a sell signal for some period of time as well, at least developed international. So within the portfolios, that's the place that we have the least amount of conviction, at least currently. And then finally, beware the crowded extremes. This is a classic symbol of how people behave and feel about things. We entered the year very optimistic. Even after the rally that we had last week, we're still in excessive pessimism, which historically has been very good for the markets. I highlight here at when you're below that 40 level, and we're currently at 30, about a 24%, 25% annualized rate of return looking backwards, daily compound return, so it's not like a year out. But nonetheless, what we've been still recommending to clients is, hey, take that money that you're on the sidelines with, that you're not going to use to live on, that you want to invest with, and invest in dollar cost average into a portfolio, and do it in a manner that is, we're doing it, recommending it into a portfolio that's still underweight equities, where we can go and then buy when the time is appropriate for that. And one more thing to note is that if we're going to wait for the economy to get better, the market's going to be long gone before that. This is looking at all recessions going back to the late 40s. Typically, on average, the markets bottom 4 to 5 months before the recession ends. So the shape of this recession is going to matter a lot in terms of defining the bottom. If we think we begin to have some sort of recovery in the second half of the year, bottoming in March was a great time to buy. If it's later than that, there might be a better time to buy. And unfortunately, I don't have that exact answer yet. So as we're positioned now, we're still underweight equities, although not as much as we were before. A couple of percentage points, 2 to 3, 4 maybe in some portfolios, not a lot. Like we invested a bit when it was low, and then because it was low, when things moved up, it became a larger percentage of the portfolio. Still, we're overweight bonds in lieu of cash, especially because cash isn't paying much right now. We're marked back to market weight roughly in the United States, and the single underweight is international. And if things were as they are now and we got the symbol to buy, likely the bulk of that would go into US equities. One place we're not taking risk is in bonds, and we still are holding a little bit shorter dated bonds than long dated bonds. So bottom line, US is very likely in a deep recession. Now the major question is, how long is it going to last? It's going to be based on science. It really is. I mean, we pretty much know that. So, and unfortunately, I'm not an expert there, but I do believe that the fiscal and monetary policy has been massive, and the stock market may have found a bottom in March, given the response, assuming that that recession doesn't take too long. Our rules that we have are beginning to support a further allocation to equities, although we're not there yet, but we are going to wait for confirmation to do so before adding to that. And as I mentioned, we're slightly underweight stocks and overweight bonds. Well, everyone, thank you very much for your trust and confidence and more or less getting through the webinar. Hopefully that wasn't too loud, the gentleman doing the leaves outside. But if anybody has any questions or I missed it somehow, an email that came in, I didn't answer your question, please reach out to me. I will have time today to try to respond to all those emails that do come in typically after the webinar, as I set aside some time. So I'll be very happy to go through those and get back to people individually. Other than that, hope everyone stays safe and healthy and gets through this okay, and hopefully on the other side of this thing, we'll go back to normal, whatever that might be.